Hey folks, welcome to a product review at Finominal. Today we're going to look at PIMCO's StocksPLUS fund, which trades under the ticker PSTKX. Now this fund is unique because it pursues a strategy that nowadays is being called return stacking and historically was called a portable alpha strategy. And that simply means that it aims to provide exposure to benchmark index like the S&P 500 plus an additional return. And in this case, the additional return is being generated from a bond alpha strategy, where PIMCO creates a portfolio comprised of long and short positions across fixed income instruments globally. So this might be short the US Treasury and long an Austrian bond, depending on PIMCO's perspective. So let's investigate in terms of what makes this fund successful, because it does manage $1.7 billion of assets. Now, the obvious benchmark over here is the S&P 500. And we do see that over a 30-year plus track record, so this fund has been practically around forever, it actually managed to beat the S&P 500, which is nice. Having said that, we also see that the excess return has not been particularly consistent. So initially the excess return was positive, then the fund, underperformed the S&P 500 during the global financial crisis in 2008. It did recover, but as you can see, there's no consistency in this outperformance. In fact, if you think about the total outperformance is only 12.5%, which is not that much over a 33-year track record. And I'll come back to that later on. Now, if you look at this, the underlying portfolio, if you look at a simply breakdown by assets analysis using the current holdings, we would see that, the PIMCO StocksPLUS fund has almost no exposure in equity and everything is fixed income. But that's wrong, naturally, and that's simply because the futures, they're not being recognized correctly right from the notional exposure. And therefore we switch this to a risk-based breakdown by assets. And there, of course, we can see that PSTKX is has almost the same exposure right as the S&P 500. It's all equities, right? We can confirm that via a short returns-based factor exposure analysis. And if you look at the factor betas to the major asset classes, we can see that the beta to the S&P 500 is close to 1, and that the beta to other assets was, close to 0. As mentioned, the fixed income portfolio is an alpha strategy, right? So this is long and short positions, which is why the beta to something like the Bloomberg Barclays US Ag Index, right, was close to 0 over time. It is worth looking at the risk of this fund, because what we do see is that although the fund outperformed, it actually has done worse in the global financial crisis, right? So over here we can see there was a drawdown of, I think it's 63% for the PIMCO fund versus 55% for the S&P 500. And that of course reflects that although the CAGR was higher over 33 years, the max drawdown was also higher, and therefore there's almost no increase in Sharpe ratio, right, between PSTKX and the S&P 500. It's almost identical. Now, what makes this fund interesting from our perspective is that you have something that kind of tracks the S&P 500, but it offers a much higher dividend yield. So the dividend yield of PIMCO's fund is 4.3%, whereas it's closer to 1% of the S&P 500. And one of the issues that we see is that lots of investors, especially ones that are managing portfolios for retail investors in retirement, that need income has replaced, or that need yield as replacement for income, often allocate to high yielding strategies that sacrifice total return over yield. And so this is like a high dividend strategy, option-based strategy, and so on. And PIMCO's fund is actually an interesting alternative in a sense that you can buy the S&P 500 or something that gives you the same return as S&P 500, but with a much more attractive yield. Kind of interesting to think about. Hope that helps. Have a nice day.